Many people think rich people are rich because they never borrow. We are often taught to fear debt. We are told to save every penny. We are warned that borrowing is a path to ruin. This is a common myth that keeps many people from building real wealth. It is a story told to keep people small and safe, but it often keeps them from growing. The truth is often the exact opposite of what we have been led to believe. The truly wealthy do not just avoid debt, they master it. They see debt not as a chain but as a key. The truth is that wealthy people use loans to build even more wealth. They understand a powerful secret that is hidden in plain sight. They borrow in smart, calculated ways. They use money that is not their own to make more money for themselves. This method is not about reckless spending or living beyond your means. It is a strategic financial tool. It is about using other people's money, to acquire assets that generate income. Acquire assets that appreciate in value. This is how fortunes are built and expanded. This essay will pull back the curtain on this powerful concept. It will explain how this method works in simple terms. We will explore the fundamental ideas behind strategic borrowing. A loan gives you access to a large amount of cash right now. Think about how long it would take to save up a significant sum of money. For most people, it would take years or even decades of patient saving. During that time, life happens. Inflation eats away at the value of your savings. Opportunities come and go. A loan allows you to bypass this long waiting period. It gives you the power to seize an opportunity the moment it appears, rather than watching it pass you by, while you slowly fill your savings jar. With a loan, you have the capital to act. Buy a piece of undervalued real estate. Acquire a small business already generating profit. Invest in new equipment to make your business more efficient and profitable. These are assets that can grow in value or produce income. When they perform well, you keep the profit. Repay the loan over time and you're left with a valuable asset plus a positive return. This is the basic idea behind using debt for wealth creation. It's about using a financial tool to accelerate your timeline. Instead of waiting 10 years to save for one rental property, you could buy one today with a loan. The rent can help pay down the loan. Before you know it, you own the asset and it's producing income for you. You've used the bank's money to get a head start on your financial future. Leverage is one of the most important concepts in finance. It simply means using borrowed money to increase your potential return on an investment. Think of a physical lever you might find in a workshop. A small amount of effort applied to the long end of the lever can lift a very heavy object. Financial leverage works in the same way. A small amount of your own money, when combined with a larger amount of borrowed money, allows you to control a much larger and more valuable asset. Let's use a simple example to make this clear. Imagine you have $20,000 saved. You could use that money to buy $20,000 worth of stocks. If the stocks go up by 10%, you have made a profit of $2,000. That is a respectable 10% return on your money. Now, let's introduce leverage. Instead of buying stocks, you decide to buy a $100,000 property. You use your $20,000 as a 20% down payment. The bank loans you the remaining $80,000. You are now controlling a $100,000 asset with only $20,000 of your own cash. Now, let's say that property also increases in value by 10% in 1 year. The property is now worth $110,000. Your gain is $10,000. You still owe the bank $80,000, but your initial $20,000 investment has generated a $10,000 profit. That is a 50% return on your original investment, not just 10%. This is the amplifying power of leverage. It can dramatically boost your gains. You are making money not just on your own cash, but on the bank's cash as well. This is how the rich get richer, faster. Of course, it is crucial to understand that leverage is a double-edged sword. Just as it can magnify your gains, it can also magnify your losses. If that same $100,000 property were to decrease in value by 10%, it would be worth $90,000. You would have lost $10,000, which is 50% of your initial $20,000 investment. This is why managing risk is so important, a topic we will cover in detail later. The key takeaway here is that leverage allows you to do more with less, punching far above your weight in the investment world. It is critically important to understand that not all debt is created equal. The wealthy are very clear on this point. They actively seek out one type of debt while carefully avoiding another. The two categories are often called good debt, bad debt. Understanding this simple distinction is fundamental to using loans as a tool for building wealth. Confusing the two can lead to financial trouble, while using them correctly can pave the road to financial independence. Good debt is any debt that is used to purchase an asset that will likely increase in value or generate income. The asset you acquire should, in theory, pay for the debt itself over time. The purpose of good debt is to make you richer. Examples are easy to find. A mortgage on a rental property is a classic example of good debt. The rent paid by your tenants can cover the monthly mortgage payment, taxes, insurance, repairs, and leave you with extra cash flow each month. A loan to buy a profitable business is another example of good debt. In contrast, bad debt is used to pay for things that lose value over time. These are called liabilities, consumer goods. Bad debt makes you poorer because you are left paying for something that is worth less and less each day, without any income to offset the cost. The most common form of bad debt is high-interest credit card debt used for discretionary spending, like expensive dinners, vacations, designer clothes. A loan for a brand new luxury car is another classic example. The moment you drive it off the lot, its value plummets, but you are still stuck with the monthly payments. The rich focus their borrowing power almost exclusively on acquiring assets with good debt. They might use a credit card for convenience, but they pay it off in full each month to avoid the high interest. They understand that every dollar spent servicing bad debt is a dollar that cannot be used to invest and grow. Your goal should be to think like them. Before taking on any new loan, ask yourself a simple question. Will this purchase put money in my pocket? Will it take money out of my pocket? The answer will tell you if it is good debt or bad debt. The wealthy have a variety of specialized tools in their financial toolkit. Loans are among the most important. They do not just use one type of loan for everything. Instead, they choose the right loan for the right job, much like a skilled carpenter selects the right tool. Understanding these different types of loans helps you see the strategy. Each one serves a specific purpose, maximizing opportunity while managing cost and risk. Let's, look at a few of their favorites. First and foremost are mortgage loans, loans used to buy property, cornerstone of many real estate fortunes. They use mortgages to buy their own homes, apartment buildings, commercial offices, rental houses, long repayment terms, often 30 years, relatively low interest rates. That combination makes them an ideal vehicle for leverage. The goal is simple: have rental income, pay the mortgage and expenses, creating positive cash flow and building equity over time. Next are business loans to start a new company, to expand an existing one. Purchase new machinery that increases production, fund a marketing campaign that brings in new customers, acquire a smaller competitor. The loan buys an asset expected to generate more profit. If the plan is solid, profits will cover the loan and drive growth. Another powerful tool is a line of credit. Home equity line of credit, HELOC. Business line of credit, a revolving source of funds you can draw from as needed. It works like a flexible, low-interest credit card. The wealthy love lines of credit for instant liquidity. If a great investment appears, a discounted property, for example, they can draw on their line to pounce immediately without a lengthy loan application. They only pay interest on what they use. Finally, for sophisticated investors, there are margin loans. Borrow from your brokerage using your stock portfolio as collateral. Buy more stocks to amplify your position. Very high risk, high reward, because if your stocks fall in value, your broker can issue a margin call forcing you to sell shares at a loss to cover the loan. Used with extreme caution, but it shows using leverage across finance. While the wealthy love to use debt, they are not reckless gamblers. They are masters of risk management. They understand that leverage can be dangerous if not handled with care and discipline. They do not borrow money based on a whim or a hot tip. Instead, they follow a strict set of rules and principles designed to protect their capital and ensure their investments have the highest probability of success. Their approach is methodical and calculated, not emotional. The first and most important rule is to know your numbers. Before signing a loan, they analyze the deal from every angle. Specifically, they focus on cash flow. Cash flow is the lifeblood of any investment. It's the money left over each month after all expenses, including the loan payment, have been paid. For a rental property, calculate expected rent, subtract mortgage, subtract taxes, subtract insurance, subtract a budget for repairs. If the final number isn't comfortably positive, they walk away. Positive cash flow means the asset pays for itself and provides a buffer against unexpected costs. Another key strategy: secure low interest rates and favorable loan terms. Lower interest rates reduce monthly loan cost, which increases monthly cash flow. This makes investments safer and more profitable. They shop lenders and negotiate hard. They consider loan term. A 30-year mortgage gives lower monthly payments compared to a 15-year loan. That reduces monthly financial pressure and gives breathing room if rental income dips. Wealthy investors build a safety net. They always keep significant cash in reserve. This is an emergency or contingency fund. If a property needs a new roof, the cash covers it. If a tenant moves out and the unit is vacant for months, the cash covers expenses without stress. This prevents forced selling at a bad time. They never invest their last dollar. Backup cash provides peace of mind and the ability to weather short-term storms. Finally, they practice diversification. Learning from the wealthy is one thing, applying their methods is another. To turn these ideas into action, you need a clear, simple plan. Borrowing money to invest can feel intimidating at first, but following a structured process can remove the fear and replace it with confidence. This checklist breaks down the process into simple, manageable steps. Think of it as your roadmap for using loans wisely. Before you make any move, run your potential deal through this simple checklist to ensure you are on the right track. 1. First, be crystal clear about what you want to achieve. Are you looking for monthly cash flow to supplement your income? Or are you looking for long-term appreciation, where the asset grows in value over many years? Your goal will determine the type of asset you should be looking for. A rental property in a stable neighborhood might be great for cash flow. Land in a developing area might be better for appreciation. Knowing your destination is the first step in any journey. 2. This is the most critical step. Analyze the cash flow, run the numbers. Do not guess or be overly optimistic. For a property, find out the real market rent. Get accurate estimates for taxes, insurance, maintenance. Subtract all these costs, including your estimated mortgage payment, from the income. Is the number positive? Is there a healthy cushion? If the numbers do not work on paper, they will not work in real life. Never fall in love with a deal. Fall in love with the numbers. 3. Not all loans are the same. Choose the right loan. Shop around for the best possible terms. Compare interest rates, fees, the length of the loan. For a long-term rental, a 30-year fixed-rate mortgage is often the safest bet because your payment will never change. For a quick project, like flipping a house, a shorter-term loan might make more sense. Pick the loan that best matches the strategy for your specific investment goal. Avoid high-cost credit, like credit cards for funding investments. 4. Before you close the deal, make sure you have an emergency fund in place. Secure your backup cash. 6 months' worth of total expenses, including the mortgage, set aside in a separate savings account. This cash is your insurance policy. It protects you from unexpected vacancies, costly repairs, other surprises. Do not skip this step. It is what allows you to sleep at night, knowing you are prepared for anything. Beyond the checklists and financial calculations, the most significant difference is their mindset. They think about money risk opportunity in a fundamentally different way. Adopting this mindset is as important as the technical steps. It is the internal software that runs the wealth-building program. Without it, even the best strategies can fail. They cultivate thinking that is patient, disciplined, focused on systems, not on luck. First, they think in systems. They don't just buy one rental property. They build a system for finding rental properties, funding rental properties, managing rental properties. The system has rules and criteria. Example rule: rent at least 1% of purchase price. Following rules removes emotion from decisions. They don't chase hot deals or get swept up in hype. They methodically execute a proven plan repeatedly. This leads to predictable and repeatable results. Second, long-term perspective, not trying to get rich quick. Building sustainable wealth takes time. They plant financial trees they may not sit under for years. Buying with a 30-year mortgage means they're prepared to hold long-term. Patience lets them ride market fluctuations. While others panic and sell, the long-term investor holds on confident in fundamentals. They let time and compounding do the heavy lifting. Finally, they value time and education. A loan can buy time. Time for appreciation, time for business growth. They invest in their financial education. They read books, attend seminars, and build networks. Networks, accountants, lawyers, mentors. Paying a good advisor can prevent a $1 million mistake. They are lifelong learners, refining strategies and understanding the market deeper. They treat financial knowledge as their most valuable asset. We began this discussion by challenging a common myth, the idea that all debt is bad. Throughout this essay, we have dismantled that myth and replaced it with a powerful truth. Debt, when used correctly, is one of the most effective tools for building wealth. The rich have understood and used this principle for generations. They do not fear debt. They respect it. They control it. They use it as leverage to acquire income-producing assets, to accelerate their financial goals. to build lasting fortunes from a small initial stake. We have seen how loans provide the immediate capital to seize opportunities. We have explored the magic of leverage, which can amplify returns far beyond what is possible with cash alone. We have made the critical distinction between good debt that buys assets and bad debt that buys liabilities. By focusing on smart borrowing, mortgages, business loans, managing risk through careful analysis and maintaining a cash buffer, the wealthy turn debt from a potential danger into a predictable and powerful ally. The path is not reckless borrowing or chasing quick riches. It is about a deliberate, educated approach. It starts with a change in mindset, viewing yourself as an investor, not just a consumer. It requires discipline to run the numbers, patience to think long-term, and the wisdom to build a safety net. The checklist provided offers a clear starting point. Start by educating yourself. When you are ready, start small, stay disciplined, build your confidence one successful deal at a time. Loans are simply tools, no different from a hammer or a saw. In the hands of an unskilled person, a tool can be dangerous. In the hands of a trained, careful craftsperson, it builds something magnificent and enduring. The choice is yours. You can continue to view debt as a trap to be avoided at all costs. Or you can begin to see it as the rich do, a powerful tool with the right knowledge and a careful plan that can help you build the financial future you desire.